$25 million in microloans from Kiva for about 4,500 small business owners.
Private companies usually riskier, obviously more upside, right? Because you're investing on earlier rounds, lower valuations. There's more upside potential as the company grows.
It's more important to let people be great at what they're great at.
I think so. Double down on your strengths. Now your kind of 10K can go around like 10, 20, 50 companies.
Can we go into accredited versus unaccredited?
Welcome to More Than the Hype, the podcast where we go beyond the surface, beyond the trends, and straight into real, unfiltered conversations about business. I'm your host, Kristen Taylor. Grab a glass of wine from KT Winery or water because moisture is important, and let's get into it because success is more than just the hype.
Hi, everyone. Today we have Jonny Price, the president of WeFunder. This is not the first time you guys have heard that word leave my lips, so hopefully this is ringing some bells. An investment crowdfunding platform. Are we allowed to say that?
We are.
Okay.
Yeah.
That enables startups to raise capital from their customers, or as I like to say, our community. With a background in strategy and consulting and nonprofit leadership, Jonny has dedicated his life to democratizing access to capital for entrepreneurs and, I would say, investment opportunities for community as well. Jonny, welcome to More Than the Hype. I'm so excited to have you.
Thank you. Good to be here.
I randomly sent this email to Jake, who has been our WeFunder guy for the last 3 years, because we had our first round on WeFunder and now this one. And I was like, hey, I don't know if anyone on your team actually would do this. The last thing I expected was to get your name thrown out as an opportunity and a way to chat. So
I love the sound of my own voice. So, yeah.
What could be more exciting and dreamy? Yeah. I love it.
Yeah.
So thanks for coming on. Speaking of your voice, you're originally from the UK.
That's right.
Okay. Whereabouts?
London, northwest London.
Okay.
A kind of suburb called Harrow. Which is famous. Harrow. Which is famous.
Terrible accent, so I'm not going to try.
That's pretty good, actually.
Else
That's pretty
that.
good. Harrow is only famous for its school, Harrow School, which Winston Churchill went to and Jonny Price did not go to.
Okay. I was waiting for the connection, but it did not come.
Yeah. It's like Eton and Harrow are the two most kind of famous public schools. Public in England means like most elite private. It's very confusing. So yeah, Prince Harry went to Eton.
Eton, yes.
Harrow's the other one.
Eton is also where the Bridgerton people went.
Yes. So you've heard. Yeah.
So that's actually where I got my my information from.
Yeah.
How did you end up in Nashville?
My wife is from Nashville.
Does she have an accent?
She honestly doesn't have that much of a southern accent.
I'm trying to imagine the dinner table with the two accents and the twang.
I kind of wish she did. But no, it's a fairly kind of neutral accent, I would say.
Okay.
My kids mostly sound American, but kind of have a slight English twang on some words.
Nice.
And they're really into Harry Potter right now. And my son is just doing an incredible English Harry Potter accent, which is very, very cute.
That's so cute. How old are they?
8, 6, and 4. So got 3 of them running around.
Okay.
So pretty
and
busy.
A nice spread between them. Okay.
Yeah, well, not that nice. When the youngest is 1 and all 3 of them were under 5, and that was pretty intense.
Oh, yeah. Yeah.
But yeah, so grew up in the UK, started my career in management consulting, as you said, at a firm called Oliver Wyman. And then in 2009, I did a sabbatical working for a nonprofit called Kiva in San Francisco. So flew over to SF for 6 months to do that. Met my wife. She was working there. We started dating. We got married here in Nashville in 2010.
Okay.
A while ago. Nashville's changed a lot since then. And then, I lived in SF. We lived in SF for 10 years and then had a couple of kids in SF. And then in the pandemic, we kind of had always wanted to move back to Nashville, and the pandemic kind of catalyzed that move. 2020, we moved out here. Then we had a third on the way. And so
Great
we've lived here for 5 years. Yeah, right.
Let's just move across the country.
Exactly. Because then we came here and no one was really going out, so it's not the best time to make friends. But we also had young kids running around.
Yeah.
So we were kind
is
of
her
pretty
family
busy.
Still here?
Yeah, and that was a huge part of it.
I'm sure that's very helpful.
Her parents and family are just so supportive and awesome. Shout out in-laws.
Yeah. Sucking up over
son-in-law
here.
points. Yep, rising up the son-in-law leaderboard there.
Okay, and so Kiva is how you say it?
Yes.
Yes.
Kiva.org is a nonprofit that was founded in 2005, and it does kind of crowdfunded microloans.
Yes.
So Muhammad Yunus won the Nobel Peace Prize for microfinance in Bangladesh. I think it was actually also 2005.
Okay.
So microfinance was this like a really kind of big concept, kind of sustainable philanthropy. And then Kiva came along, and it was like enabling basically, rich people in America to make $25 loans that were then crowdfunded into, let's say, a $200 micro loan to a farmer in Kenya or Cambodia. And then she would, I think maybe 80-90% of the borrowers were women. Like, she would repay the $200 loan, and then the Kiva lenders would get their $25 back, and then they could re-lend that to help someone else.
Okay, because it kind of goes into like a Kiva account.
Yes,
and then you can
exactly.
either push
you
it
get
back
repayments,
out, or
exactly.
you could take it if you need it to take
but
it out.
But no one ever takes it out.
Why would
They're
you?
just going to recycle it and re-lend it. So,
Yeah.
the first $25 Kiva loan I made in 2009 is probably now cycled 20 times.
Wow. So just a little fact about it. So $25 million in microloans from Kiva for about 4,500 small business owners in the U.S. alone, actually. So this isn't just abroad.
This is deep research
I
for this
told you,
podcast. I'm impressed. Yeah. So,
get into it.
so Kiva.org was initially for micro lending in the developing world, Africa, South America, Southeast Asia. And then in 2011, I started the team that was bringing that model to the US. So the numbers you cited there are just with the US part of Kiva.
Right.
The internationally, I think it's over $1 billion at this point, deployed to probably millions of entrepreneurs at this point.
But what a way to see the actual impact. I think that's maybe what's most exciting is you can actually track the impact, and you can also track that, this works because it's getting paid back. Yeah,
it's very direct, and that kind of model of like recycle. And Kiva was very kind of philanthropic. Even the US loans, bringing the model to the US, it was lending to a barbershop in inner city Detroit or a small family farm in rural Arkansas. But it was still very much like kind of philanthropic. Like the most you could get back was your principal. Yeah. And so there were kind of some challenges in terms of scaling that business model, which, brought me onto WeFunder. Do you like how I did that? Just seamless segue.
I got you, Kristen. Beautiful.
Yeah.
We don't even need to edit that one.
Yeah.
You're welcome, Steph. Democratizing investment for communities, for business owners. So you're now the president at WeFunder. Tell me kind of a little bit, for people who don't know about like the founding team, how this got started, when it got started. Give the whole rigmarole, the spiel.
Yeah, so
it's really cool.
WeFunder was founded in 2012. So we had 3 co-founders, and they were kind of serial entrepreneurs, and they wanted to invest in their friends' startups. And they were not able to do so because they were not accredited investors.
Yeah, can we take a little pathway?
A little detour.
Yeah, because we've raised about $1 million from outside investors, which would be accredited. And then we raised a little, I think 125 on WeFunder through non-accredited. So it was a lot of explaining to people the difference and why this is now legal and that wasn't legal before.
Yeah.
And how, you may have invested in your friend's company. Maybe it wasn't completely legal because you didn't make X amount of dollars. Yeah. So can we go into accredited versus unaccredited?
Yeah, so the simple definition is accredited investors are rich people.
Yeah.
The technical definition is to be accredited, you either need to have $1 million of wealth, excluding your primary residence, or make 200K income or 300K household income for the last 2 years. And you can also qualify by doing some tests and a couple of other ways, but generally income or wealth, right? And kind of richest, maybe 5-10% of the population, something like that. So that's the definition of accredited versus unaccredited investors. And there was a Securities Act in the US in the 1930s, which basically prevented unaccredited investors from investing in private companies. So IPO, initial public offering, that's when a company goes public on the stock market. Right. Before a company goes public, there's a private company. And so the SEC said for 80 years, you can't invest in private companies unless you're accredited. And by the way, there are some valid reasons for that.
No, right? It's protection.
It's protection.
We don't want you to lose money you actually need. And I think the idea there is that if you're making $200,000 a year, you could probably afford to make this risk. You may have the financial literacy or leniency to bob and weave. But if you're making $60,000 and you're investing,
exactly,
10% of your annual income, that could really hurt.
Yeah. And I think that's where the law initially came from, right? In the early 1930s, aftermath of the Great Depression. I don't know the history, but I imagine like people had lost a lot of money investing in like, slightly dubious private investment opportunities. So that was where the SEC and the government were coming from in terms of like protecting retail investors. And two big differences: private versus public investing. Right, private, they're much more kind of unstable companies, right? They're much riskier companies. Like most public companies are not going to go bankrupt tomorrow. Private companies tend to be a lot riskier. And
although they are going bankrupt left and right nowadays, guys.
Yes.
So
true.
we're seeing bankruptcy notices all the time.
Yeah.
Which goes back to my whole passion around startups. Like, yes, we say this is so safe to invest in Frontier Airlines, but they're on their like fourth bankruptcy, right?
Yeah.
So that's just a side note. So go ahead.
And so public investing is risky as well, yes. But yeah, kind of private companies usually riskier. Obviously more upside, right? Because you're investing on earlier rounds, lower valuations. There's more upside potential as the company grows. But kind of as with all investing, right? Higher risk, higher reward usually. And then also private investing is illiquid, right? If you invest in a public company on the stock market, you can turn around and sell it tomorrow. With private companies, usually it's a longer hold. There are opportunities to sell on the secondary, it's called, to sell your investment, but it tends to be a little less liquid. So anyway, so good reasons why, there were protections in place for retail investors. But our founders came along and said, it's not fair that we can't invest in our friends' startups. Like that these interesting investment opportunities are only available to rich people is not fair, and it's not very American. It sounds like something that the people at Harrow School would be big fans of, the Bridgerton crew. But, this is an American. So they set about changing the law. And in 2012, they were in the Rose Garden with Barack Obama when he signed into law the Jobs Act, which basically paved the way for ordinary people, middle-class Americans, unaccredited investors being able to invest in startups. So in 2016, the SEC rolled out the rules. So May 2016 was when WeFunder kind of, we've been around for 4 years up until that point, kind of twiddling our thumbs, waiting for the laws to go live. But May 2016, the laws went live. Okay, now everyone can invest in startups they love, not just rich people.
Yes. I mean, I think two of the biggest examples, one being forever ago, Uber, right? If people had access to invest in Uber, the upside was insane, right?
Yeah.
1,000x return basically at this point if you stayed in. Poppy just went under their $1.9 billion with 300,000 in tax credits, so $1.6 billion acquisition. Wow, those investors are very happy right now.
Right.
And if they had done a community round at some point, that's how WeFunder would have come into play, right? Of you have a chance to sit at the table.
Yeah. If you got into the seed round of Uber, then, when they IPO'd, I don't know, it's like thousands of X return, right? So the average investment on WeFunder is $1,000. So if you invest $1,000 in Uber seed round, you're becoming a millionaire at the IPO. It's like life-changing money.
Absolutely.
So we think, wouldn't it have been cool if at the Uber IPO, like thousands of drivers, like their earliest kind of supporters and like stakeholders had become millionaires alongside Jason Calacanis and, whoever the VCs were that were in the kind of early rounds.
Yes.
And of course, a lot of startup investments will go to zero. And so there's, it's super risky, but we would love to kind of have more of those wealth creation opportunities kind of available to retail investors, especially because more and more companies now are staying private for longer.
Yes.
So like SpaceX is a good example. They're huge. They're still not public. And so if retail investors can only get in on the investments after the company goes public, and more companies are going public later and later, more of the wealth has already been built by that point.
Yeah, it's happened. Also, the share price is going to be insane. So how much can you actually accrue, right?
Yeah.
But you were also at the Federal Reserve Bank, or can you explain that random but very important piece of your career?
not that important, more
Well,
random than
maybe
important,
validating.
but yeah,
Yeah.
validating maybe. Yeah, when I was at Kiva, I was asked to stand on the Community Advisory Council of the Federal Reserve Board, which basically is mostly kind of nonprofits or kind of leaders that have kind of insight into and are working with maybe kind of lower moderate income communities. And so we would go and present to the Board of Governors, including Jay Powell, in DC, in the boardroom of the Federal Reserve every 6 months about, as the Fed are kind of contemplating like monetary policy and where to move interest rates, so that voices of kind of low moderate income communities were like in those kind of conversations and discussions.
I love that, because we talk a lot in investment, and when you go to pitch the VCs, they still ask if you did a friends and family round,
Mm-hmm.
and most people of color do not have access to that.
Right.
So this kind of, to me, really loops together.
Yeah.
And WeFunder kind of becomes that,
Yeah.
and has the ability to be that, or a community round rather.
Totally.
Either way, but from my back end of raising on WeFunder, it's really both, right? The people who wanted to write me a check but weren't accredited investors from my friends and family actually do come in, because you have to hit a certain threshold before it goes public, right?
Right.
So
$50K.
$50K. So it gives you that optionality to actually bring in people who would love to, but maybe just don't quite understand or have the know-how. And then the platform kind of takes you through the experience of what diligence maybe could look like for you.
Yeah.
And then it goes out into the community and into your broader network of investors, right?
Exactly. Yeah. And WeFund is, a two-sided marketplace, right? We have investors and we have founders like you. And the idea, as we've been talking about on the investor side, why should only rich people get to invest in cool startups I love? Like, let's democratize angel investing so everyone can invest in a startup they love, whether it be wine company, whether it be a tech startup, whether it be a biotech, or whether it be a restaurant or a coffee shop in the neighborhood. And then on the other side, on the founder side, the idea is that if we have more people investing in startups, we can get more capital flowing to founders. And especially, talking to you, I think 1% of VC dollars today goes to Black founders. 2% of VC dollars, you probably know these stats better than I do, 2% goes to female-only founders versus 80% to male-only founders. And by the way, if you're a Republican or you don't like DEI anymore, then I'll say that 77% of VC dollars goes to 3 states, and they're all blue: California, New York, and Massachusetts. So we say, well, if we can get, and this is in our public benefit corporation charter, we're a PBC, if we can get more women of color in Tennessee here empowered to be angel investors in founders that they know and look like them, maybe we can get more capital flowing to women of color in Tennessee who are starting businesses.
Well, we're also seeing, we're in the middle of the greatest wealth transfer of our lifetime, right? Where women are actually going to be the predominant wealth holders, which is a beautiful transition. But a part of that has to be women writing more checks and actually growing investment. And once again, democratizing that, so other women who maybe haven't been privy to that before, weren't in finance before, can now step to the table and actually be a part of that wealth transfer.
Totally.
And be a part of that majority versus, still feeling left behind.
Yeah. I don't know the stats on like the breakdown of GPs at VC funds and, the ethnicity, gender.
It's not much different than what we just said.
I would imagine it's very closely correlated.
Yes.
And if we can kind of enable more women to dip their toes in the waters of angel investing, because the other thing is like, let's say, and the SEC actually have limits on how much you can invest through this regulation crowdfunding exemption every year. So one of the ways they protect the retail investors is, if your income is only this or your wealth is only this, you can only invest a certain percentage of that every year in private companies. But let's say that kind of allocation, I have $100K of capital that I want to invest, and I want to do, whatever, kind of most of it in less risky assets, maybe real estate, public equities, debt, whatever. But there's like an allocation that I want to invest in startups. Maybe it's $5K or $10K. In kind of conventional, like accredited investor land, that's one check. and startups are really risky. And ideally, you want to kind of spread it around a little
Right.
bit and like diversify your portfolio. So on WeFunder, we kind of, because we massively lower the minimum check size. I don't know what it is for you. Is it
$100. We
$100
made
bucks?
100 on purpose.
I love that. That's like the
Yeah.
minimum we allow on the platform. So now your kind of 10K can go around like 10, 20, 50 companies.
Right.
And you're getting reps and at-bats and learning what to look for and learning, the kind of lessons and kind of mistakes that you make in your first few investments. You can kind of make more of those and diversify your portfolio, even with a smaller kind of allocation that you want to kind of give to investing in private companies.
Well, you also get access to deal flow you never would have gotten before.
Totally, yeah.
Because half of these deals would never come across your desk.
Right.
There may not be anyone in your network that
Yeah.
is privy to them.
Yeah.
Second, I think you also can grow your due diligence ability.
Yeah.
Because now you're starting to see trends. Now you're looking at,
Right.
because if you go into WeFunder, for instance, like go to a campaign page, you'll see all the pretty fun stuff, right? The storytelling, what they've done before, what they're doing now. But then you actually can go into the tabs and look at financials, and it can be confusing as someone who, has put our financials in there, but also runs our financials with our accountant all the time. Looking at the actual numbers there and, okay, this is how much they've previously raised. This is where
Right.
debt is sitting. This is where this is happening. Because sometimes I will say you see, not necessarily on WeFunder, just in general, you'll see really bloated revenue numbers.
Totally.
And then you'll look at expenses and go,
Right.
wait, they spent 40% over that. So they're actually
Right.
not doing great. And then sometimes, these are the companies I've invested in. I'm like, oh, nice. They're really fiscally responsible.
Right.
They're killing it. They only spent X amount here.
Yeah.
I've invested in several companies through WeFunder once we were on the platform because
Love it.
one, they were companies I have heard of before. So I knew the brand awareness was there. The passion was there for me because I was already like, okay, I like the founder story. Then I got to dive into the economics and was like, oh, this makes total sense. They need revenue. They need money. They need cash so they can bring it to the next level because they've already done so much with so little. And that's the story I think I'm seeing the most on WeFunder is people who actually have done the work.
One of the things I love about the platform is it's democracy, right? And democracy is, I think, cool. I think it's a Winston Churchill quote. It's clearly Winston Churchill interview today. We're just going to talk about Winston Churchill in a bunch of different ways. But Winston, thanks for your work saving England during the Blitz. But
I went to a super, which is funny because if you know me now, I'm very much not Republican. But I went to a super Republican school from 3 years old to 17, like Christian school, whatnot. We talked about Winston Churchill way more than you think a person should.
Yeah.
Like how is Winston coming up in math class? But here we are. So this is actually really fun.
I went to
my professors.
I went to the Imperial War Rooms, which is where he was kind of planning the like British defense against like the Nazi Luftwaffe during World War II. It's really, really moving actually for an English man. But I think it was him. Now it's not going to be him that said this, but I think it was him that said democracy is the worst form of government we have, apart from all the others.
Well, we can change it on Wikipedia if not.
Yeah, we'll just edit it. Yeah. Winston definitely said that.
Yes.
But there's a lot of problems with democracy, right? Depending on your political perspective.
I think every political perspective, whatever, no country has it completely right.
Right.
Regardless of whatever side you're on, there's so much opportunity to make it better.
Yeah.
Regardless of whatever country. That's just the fallacy in being human. We have to have an ability to get better. So
and that's kind of the point I was going to make is that like in a country of 330 million or even in a country of like 50,000 people, there's going to be a massive diversity of opinions. And so when you invest in WeFund, okay, you're looking at the fiscal kind of responsibility of the founder, or you're looking at whatever kind of criteria is interesting to you. And there's going to be other investors that are looking at something totally different, right? And we have, the Oakland Roots soccer team just raised $3 million from their fans. And I imagine most of those fans weren't looking at the balance sheet.
Definitely
not. They
just
think it's like really cool to be an owner of their local soccer team. Chattanooga FC down the road from us here in Nashville. They also just, raised $800,000 from their fans. We have restaurants, and you might have people in the neighborhood invest in that restaurant because you want that restaurant to exist in your neighborhood. Some people might invest in a founder that they know, right? Some people might invest in a cure for cancer in dogs. This company, Leah Labs, trying to cure cancer in dogs. Went through YC. They were seen as too risky, too early by VCs, so didn't raise from VCs, but came to a community of dog lovers and raised a couple of rounds on WeFunder. So my point is, like, the motivations that people have for investing are very kind of diverse.
Yeah.
Even within the same company raising, which I think is kind of a cool aspect of the WeFunder
Definitely.
kind of democratic model.
I think, if you were to look at the mix, and because when you invest, you get to leave a comment, and people can tell you why they invested, which has been fascinating.
Yeah, that must be fun for you to read those.
It's
like very
so
validating,
fun.
right? Encouraging.
Well, and sometimes, Macy, my co-founder, and I's moms always
Yeah.
And it's like, it's funny because whoever does it first is like, my daughter, Kristen, my daughter, Macy. And they're both hilarious. So it's actually always like, oh my God, hide comment from Paige. This is so inappropriate, Mom.
Yeah.
Why is that there? But some of the comments you get back are like, I really respect the business model,
Right.
Maybe that's 15 to 25%.
It's probably a minority.
The rest is, I love mom juice. I love drinking it. I love
Love the brand. Love
the
Kristen.
brand. Love the founder story.
Yeah.
Saw it on a news article, or
Yeah.
So I love how varied it is and how people's inspiration for investing has changed. And I also like that you guys are actually hitting the mission. You actually are democratizing it.
Yeah.
People are starting to understand that this is not a donation.
Yep.
There's something in return. But there are a couple of models on WeFunder, right? Can't you do other options other than a community round where money in exchange for shares or equity?
Yeah, it's
I'm
any
changing
investment.
my words because there's been an adjustment, right?
I appreciate the investment crowdfunding that you asked at the start. Like, do I need to put money in the swag jar? Yeah, we'll allow it though.
Yes.
We'll give you a pass. But yeah, you can do equity or debt. So any investment structure, not donations, it's not GoFundMe, it's not Kickstarter. So it is an investment. You're offering a rate of return to investors,
Right.
But it can be a loan with a 5-year term and an 8% interest rate, or it can be, we do revenue share loans, different kind of forms of equity. But yeah, any form of investment structure. I love the investor notes, by the way, just going back to that point. Like, we have a Slack channel at WeFunder that shows every investment and then shows like the comments from investors.
Oh, I love that.
And I couldn't agree more. Like, the vast majority of them don't even talk about like, I'm investing to make a ton of money.
Yeah.
It's like, I'm investing because it's a founder, a company, a cause I believe in. I think every founder should do a WeFunder just for the pure like emotional fillip, like the kind of positive encouragement of like getting these hundreds of investor messages, right?
Yeah.
It's, being a founder is a lonely, hard, grueling journey. And so if you have like hundreds of people like on your team cheering you on with their money and their words of affirmation, like, it's a nice thing in the world.
Seeing that $100 investment actually, obviously seeing the $2,500 and the $5,000, those also
those
feel
are
very
welcome
good.
too. Those are very
there's
welcome
a lot
too.
Of part.
Yeah.
But the $100 ones are always interesting to me because the comment is, this is my first ever investment.
Yeah, I see so many of those.
I'm so excited. I'm a mom and I want to create a future for my children. I'm a mom, or I'm a woman. I've never done this before. I saw someone talk about angel investing, trying to see if this is for me.
Do you know what percentage of your investors are women?
Oh, I mean, my guess is like 95%.
Exactly. So going back to the point earlier of like, who are holding the purse strings and like making the investment decisions for VCs today, right? Or banks or whatever institutions are investing. Overwhelmingly overwhelmingly white men in Silicon Valley, right? And yeah, great example. Like so many kind of women funded companies or companies like geared towards women. You see like so many of the investors are women. It's like, this is awesome.
No, I love it. And because it actually shows the makeup of the world and how things get done. Like, I think, what is it? 85% of consumer purchases are made by women throughout the world. 93% of all food and beverage purchases are made through women. And 85% of men's clothing purchases are made by women.
100% in my case. Yeah.
If we don't do it, we have a big say in why, what you're going to get.
But yeah, the people making the investment decisions on which of those clothing companies or consumer companies to
are old white dudes. And don't get me wrong, I'm cool with that. I'm cool with old white dudes, whatever. But we got to diversify the actual people making decisions. Because, I walk through the store sometimes. I'm like, who said yes to that?
Yeah.
that was a weird call.
Yeah.
You know, no woman wants to wear that or look at that. Like,
Yeah.
that's weird, you know? So it's interesting to see this wealth transfer. I'm also hoping that means consumer wants will align a little bit more in the next few years as well. Let me ask you a nuts and bolts question. How does WeFunder make money?
We charge
Talking about Kiva and how it's kind of hard with that cycle. This is very different, right?
Yeah, WeFunder charges founders a percentage of the amount they raise, so 7.9%. So if you raise $1 million on WeFunder, we keep 79K, send you 921K. So that's basically the main way we make money, which, as you say, is kind of a sustainable business model. Last year we were profitable for the first time.
Congratulations.
Which
Because you guys
good.
raised on WeFunder, correct?
Yes.
Okay.
Yes. Eating our own dog food, as they say. We've raised 20 million, I think, now down the years, from 8,000 people on our platform. Wow. And one thing that's really cool, I wrote a LinkedIn post about this recently. If you look at, because we've had 400,000 people make an investment on WeFunder. Of those 8,000, so only 2% have made an investment in WeFunder ourselves through the platform. And if you look at those 8,000 people, they reinvest and they're kind of much more active. I think it's 3.5x, I want to say.
Yeah.
More investments than the kind of 392,000 people that haven't made an investment on WeFunder. And that's kind of part of the pitch to founders, right? There's kind of two reasons you do WeFunder. One, we think we can make it a little bit easier to raise capital. And then secondly, especially for a consumer-facing business like yours, if you let your customers and community members invest, then they're going to be more loyal. Yes. And they're going to be more passionate brand ambassadors, and they're going to have a higher lifetime value, spend more money with you, churn less. And we've definitely seen that ourselves.
Yeah, I mean, I'm sure Jake will tell you this, but we did so much research before we chose WeFunder the first time. We interviewed every single platform. We had a lot of conversation. And one of the reasons we chose you guys the first time was it didn't feel like a popularity contest of, you know, one platform who we won't name, of course, asked us, how many followers do you really have? And it was so jarring of like, oh, wait, what? I thought we were raising from our community, our customers, et cetera. I get it totally. But like, are you guys going to help at all? Or it's just all of, you know, whatnot. The other piece was like the different fee structures were really complicated. It was really hard to compute what we actually were going to get from it. And then there were different thresholds. And so I really like the simplicity behind WeFunder and how you guys have set it up, because the last thing you need as a founder is another complication.
I think I would argue with by far the most founder-friendly platform. I would say we are a team of founders, and we really kind of, every like design decision, we're trying to come at it from that like empathetic kind of founder mindset, founder mentality.
Yes, I love that. Obviously, we're raising a WeFunder, so a couple of mechanics just for people so they know. What is the minimum you have to raise as a company? But we already said $100 is the minimum for customers. So what is the minimum you have to raise to get your money out? And what happens if a company doesn't raise it?
Yeah, so you could set it the minimum anywhere above 50K or between 50K and 5 million. Most companies will set a minimum of 50K. Then as long as you raise more than 50K, you can keep what you raise up until your maximum goal, which can be anywhere up to $5 million per year. And then if you only raise $27,000, then the campaign is a failure. The money goes back to the investors. WeFunder
never touches it,
WeFunder doesn't take any money. We only get paid. There's no upfront fees to launch as a founder. We only get paid if you successfully close on the platform, and then we take the 7.9% of that. But yeah, that's 50K minimum.
What type of companies do well on the platform? I say this knowing the type of companies on the platform. But for everyone else.
Companies with a community that loves the company.
But we say that, but there is a deep tech, whatever community. There are some companies raising millions and millions of dollars, doing really complicated things. And the comments are everyone's just so excited. I'm like, I don't know what they're saying, but so they hit 5 million in 4 days, you know, crazy things.
The sweet spot, the ideal customer profile, right? As the saying goes, is, I would say, companies with a large community. Oakland Roots example I mentioned earlier. Substack is a newsletter platform. If you know Substack.
Substack is blowing up right now.
Yep.
Killing it.
So they did a community round on WeFunder. They raised $5 million in 24 hours from 8,000 of their readers and writers, right? So if you got this huge audience of customers that love you, send one email, raise a bunch of money from those people. So that I would say is a sweet spot. But to your point, it's not limited to that. And we have the Leah Labs example I gave earlier, the kind of company curing cancer in dogs. They're a biotech company that's like years away from, launch. So they don't have a big social media presence, but they raised $500,000. The founder hustled. He went and pitched his network, pitched investors, and then he got on WeFunder, and WeFunder investors were really interested in it, right? So, Pirouette is another YC company that's kind of revolutionizing how kind of injections are done. Like, you go to the hospital and they try to inject you and they miss, which in life-threatening situations can be really bad. So they're using technology to basically make sure you never miss. Really, really cool company. They just closed a couple of weeks ago. They maxed out the $5 million. I think it was 85% of that money came from WeFunder investors, and only 50. Yeah.
This is going to be my point. Some of our investors from our last round one was in Saudi Arabia. He did like $10,000. I've never had a conversation with this man before.
Wow.
But he is a avid investor from WeFunder. Like, because you can actually go to the WeFunder profile, see other companies they've invested in, et cetera, about approximate amount.
We don't show you the dollar amount.
Yeah.
But you can see the different companies that someone's invested in. If their profile's public, they can make it private. But
it really led me to this, like, oh wow, what a cool just like platform, because you are getting so much opportunity to talk to people you've never spoken to before, or getting people to be excited about it. And so, I love it. It's so cool.
What I like about it, it's both. There's definitely that, right? You get in front of the WeFunder investors. We have 1 million registered users now. 400,000 of those have made an investment. 40,000 are accredited investors, and we'll put you in front of those guys. And obviously, some people are searching for wine companies, right? Or Colorado companies, right? Or female-founded companies, right?
Yes. And because you can shuffle between female-founded, minority-founded,
there's like different ways to search and kind of filters on the explore page. But then also, it's a platform that enables you in your own kind of marketing and fundraising efforts to get in front of more potential investors. Because normally when you're fundraising, we talked before about like normal fundraising is limited to rich people, accredited investors.
Right.
But it's also usually limited to private solicitation, right? Which means like you can't talk about it on LinkedIn or Twitter or TikTok. You can't put out a press release. And so with the exemption, the law that we use, regulation crowdfunding, as well as being able to raise from everyone, now you can send an email blast to your customers and all of the people getting that email can invest. So it's also a tool, a platform that enables founders to raise more money from their own network and their own kind of marketing efforts, as well as then, as you say, putting you in front of the WeFunder investor community.
I love it. So the biggest question we get from people who may be more savvy in investments, but may not quite understand startup investing is, when do we get our money back? And, I always try to explain the different types of liquidity events that could happen.
Yeah.
Are you able to, that way I can just click this and send them the link?
It's complicated, right?
It is complicated because it varies company
It varies massively, right? Like, and there's some it obviously depends on the industry sector, depends on the investment contract. For a consumer packaged goods company, you may get lucky. It depends what you define by luck, right? But you might invest in a company and then a year later they get acquired by Diageo, right? And so it might be just 1 year and you get a kind of 2x
sometimes
or 3x
it's 10,
right? And sometimes it might be like, well, that founder wants to go big and go public, and so then maybe it's 10 years. And then after 10 years, maybe you get 100x return, right? And like I say, you do have the technical ability to, if you can find a buyer for your shares in the company, you can kind of trade that out. So you can try to get liquid, like sell it on the secondary. And most startup investments will go to zero. It's like whereas like
high risk, high reward, though.
Exactly,
right?
exactly.
Yes.
Most investment in public companies won't go to zero, or at least not like maybe over 50-year time period, but not in the short time period. But yeah, investing in private companies, we always try to flag it's risky. We definitely want people to know what they're getting into, and not invest more than they can afford to lose. But yeah, so there's really kind of a wide range of outcomes and kind of time horizons.
Yes, absolutely. And I think liquidity events are really interesting. And this is kind of more so my PSA. If you're in WeFunder and you scroll down to the bottom and it says why invest, there's usually something about what type of liquidity event they're looking for. Acquisition, strategic partnership, IPO.
Yeah.
We want to hold on to it and make it a legacy company.
Yeah.
Maybe we want to buy back our shares.
Yeah.
You know, there's a lot there
Yeah.
to actually dig into, and you have to figure out where your risk tolerance is.
Yeah.
I think this is interesting to me because I personally am less interested in like an immediate liquidity event. Like that's how my portfolio is set up.
Right.
You know, I have my S&P 500s. I have my startup investments, which some of them were very strategic and some of them were like, I really like this plant company.
Right.
The Sill, we love you guys.
Yeah.
Or Kin Apparel or whatnot. I really think I see something there, but I know that they're heading to acquisition. These guys are probably holding out and whatnot. So there's also a way to stack your portfolio with maybe some variance in years.
And to your point, like there's a Q&A feature, right? You talked earlier about the investor comments where investors, after they invest, it's like you can leave a note for Kristen. There's also a place where they can ask a question. So maybe, if you're considering making a WeFunder investment, ask the founder a question. Hey, what are your plans for exit? How do you see investors kind of, exiting and kind of getting liquid? And then the founder has a chance. Maybe they already answered it on the profile page, as you say, but if they didn't, they can answer that as an answer to your question on the WeFunder, on that section of the WeFunder page.
I love it. Okay. So now we're going to get into some rapid fire.
Love it.
But last question before then, how do you work as a president of a company? I think startup founders, right? We are looking at the next 5 years of like, okay, do I want to stay CEO? Do I want to bring someone in? Maybe I move as a creative director, et cetera. And then there's also this idea of like, oh, a president, what does that person do versus a CEO or an active? How do you guys work together on your team?
Yeah. So, I mean, honestly, like I imagine the president title can mean different things in different companies, right? In WeFunder, it means kind of mostly focused on kind of external. So I've kind of been running the business development team for a number of years. So kind of, meeting with founders, VCs, investors, accelerators, partners, trying to get the word out about WeFunder to kind of founders, basically that side of the marketplace. So kind of pretty external kind of business development, growth, marketing is kind of what a president means at WeFunder. On the kind of more meta question of like as a founder, like kind of how the role evolves. I listened to this great podcast. The Logan Bartlett Show is the show. He's a VC, and he interviewed Matt Mochary, who's like a coach of founders, like the kind of Zuckerbergs of this world. And Matt Mochary said on this podcast, he talked about this concept of zone of genius. If you know that, it's like, what's your superpower? What's your zone of genius
versus genius? And
right. And so he says all these CEOs, like they kind of have an expectation of what a CEO should do, right? And obviously there are some ways in which that's kind of unavoidable or important. But what he encourages CEOs to do is to say, okay, what are you best in the world at? And do that. And actually the role of a CEO or a president or whatever the title can mean different things. And like you can hire other people on the team to complement you on the things that you're maybe less good at.
Yes.
But if you try to do those things because you think that's what a CEO should do, that will drain your energy and you won't be the best in the world at that. And so if you can try to like build a team that enables you to then focus on the thing you're amazing at, which might be sales or it might be operations or it might be, finance or whatever, talking to investors. But that's kind of I learned this kind of concept maybe a couple of years ago, and it's like totally flipped how I think about building teams and management, where it used to be, okay, like we have a role on the team that's open. Let me hire someone and let me change that person or fit that person into the open role. And now it's like, okay, we've hired this A player, they're brilliant, like, and we'll kind of adjust the role to fit their superpowers and enable them to like be the best kind of employee of WeFunder that they can be.
Yeah.
So I think I love the concept.
We as a team in the last year have started really leaning into that because we were trying to get people to do all these things.
Right.
And we realized that it's more important to let people be great at what they're great at.
I think so. Double down on your strengths, your zone of genius, versus trying to like improve on your development objectives. And then you'll never actually be amazing at that thing.
Yes.
And also you'll be kind of unhappy and miserable because you're doing something that you weren't born to do.
Well, because then you start checking in on people and you're like, why didn't you get that done? And they're like, oh, I'm avoiding it.
Yeah.
And so we ended up hiring some contractors who love really niche things that we need to get done.
Love that.
But it makes them so excited.
Yeah, love that.
You know,
it's
and
brilliant.
like, oh, great. So we're helping other people do this thing. My assistant is not miserable trying to plan my travel.
Right.
Because she's filing these tax forms, which are way more important.
Right.
But, you know, so it's a really interesting concept. So I need to actually read the book.
Yeah.
Yes.
Well, I haven't read the book. If there's a book, I want to read it. But yeah, this was the podcast episode, but I would highly recommend it. Put it in the show notes, Kristen.
I will put it.
Professional podcast show notes.
We do have show notes, so we will
Look
put
at
it there. Okay, fast round questions. Ready?
Let's go.
What is your go-to productivity tool?
I'm gonna say Superhuman.
Same.
Superhuman.
It's changed
I love
my
it so
life.
much. Rahul, if you're listening, do a community round.
Please, I would love to invest.
Let us invest.
I'm not rich enough for the other one, so.
Yeah, so good. It just like makes emails so much faster.
I will definitely put that in the show notes because it has actually actively changed my life.
Yeah.
Especially I'm super ADHD and I get a lot of anxiety if I look at my phone and have all these emails. But I know that I need to answer this on Wednesday at 2 p.m. The scheduling feature has been the biggest game changer for me.
The boomerang when it like
comes
back
in your inbox. It comes back
inbox.
to you on Wednesday at 6 a.m.
Come on, Kay.
It's fantastic. Come on, Kay. Yes.
I started my career in management consulting, right? So I was in all like Excel shortcuts.
Right.
Like never use a mouse, just like going around
I love it.
the keyboard on shortcuts. And Superhuman kind of allows me to do that in email.
It's so great.
Makes me very happy.
It does make, and then it gives you like, yay, you got down to 0. Congrats.
Yeah, nice
this
picture.
Is your, I've hit, what is it? Like 150 weeks of down to 0 in my inbox. It's just like, yes.
All right, little humble brag there
it's
from
not
Kristen.
I am very boisterous about it. Okay, best business advice you've ever received or given?
I honestly am gonna say that zone of genius thing.
Okay, that's valid.
I've both received it and now given it.
It's true. I love it.
Yeah.
Most underrated tool for founders raising investment or funders looking to invest.
Racing.
This is an obvious plug. Don't miss this opportunity.
Yeah, if only there was a regulation crowdfunding platform that I could. I mean, obviously WeFunder.
Mm-hmm.
I'll actually give another plug to my friend Maria Springer at Capital Department. Have you heard of these guys?
I've not.
I don't know if tool's the right word, but they're an agency that helps founders raise capital, either like Reg D kind of conventional like venture rounds or what we do, community rounds. Okay. And so a number of companies that you see raising $5 million on WeFunder, they're working with the Capital Department, putting together.
Give me Maria's number.
I will.
Okay.
Yeah, she's amazing. And she really, really cares. We actually first met, this is funny, when I was running Kiva US, we started also doing it in Kenya. And she was running a nonprofit in Kenya. It might have been a for-profit social enterprise, actually. So we connected randomly in Kenya and Nairobi in like 2012 or something. And then we both kind of are now doing like investment crowdfunding, and we collaborate very closely. But yeah, she'll put together the WeFunder page and make it look absolutely like world-class and beautiful, but then work with you on your fundraising strategy and building lists and segmenting different groups of investors and working on the email copy. And she's just absolutely world-class at what she does. And Selma and the rest of the Capital Department team. Yes. Capitaldepartment.com, but it's DEPT, capitaldept.com.
We love when a woman-owned business is the
so
most
good.
Underrated tool. Favorite TV show you're watching or favorite podcast you're listening to? You can't reference the same one. You have to give me something different.
Okay. maybe a hot take. Least favorite White Lotus. I'm like kind of watching it because
Buddhism.
what's
That's
that?
all I've seen. There's that one little clip. Buddhism.
So yeah, is that the Southern lady?
Yeah.
Yeah. So I watched the first 2 series. My wife is sort of really into it. She kind of like forces me to watch it, but it's just like it's too slow for me. It's just like, give me the plot. I don't know. I like got 3 episodes in and I was like,
I haven't made it past like 10 minutes.
Beautifully shot, like very artistic, like love it, like amazing. But man, character development, but just like give me the plot. Where's the action?
Yeah. Give me the good.
But like, okay, TV show I just like have The Office on repeat and The West Wing on repeat.
I'm rewatching Grey's Anatomy for the 9th time. So
Okay.
I'm very much like,
Yeah.
Okay. What is one trend that you think is going to take off in startups? Whether, we're prebiotic soda, I think is going to happen a lot because people are going to try to ride the poppy train. Like, what are you peeping as like, this is what's going to be the next, not necessarily the next big thing, but the next like maybe bloated area?
I'm going to be like super kind of self-absorbed here.
Yeah.
And say community rounds, like the idea that, sorry, I know this like so obnoxious, but yeah, the idea that like, especially for consumer facing companies, like that your stakeholders and customers and supporters and community should get to benefit from the business you build and the wealth you create alongside rich people and, VCs. That just seems like inexorable. And so, yeah, every industry has been democratized, right? Like Airbnb for hotels and Uber for taxis and Robinhood for public investing. And so WeFunder is that for private investing. It seems we're heading in that direction. Like for me, the whole kind of Web3 thing was kind of related to that. It's like decentralized kind of stakeholder participation in the economy.
Yes.
More people that's like the promise of democracy, right? You want to vote, you want to say in the kind of, private like investing, most people don't have a say in that, and it just doesn't seem right or fair to me. So I feel like now the laws have kind of changed to allow, I think, more customers will demand like participation and kind of equity ownership. And I think founders like you that kind of give them that opportunity, which they can avail of or not, it's up to them. I think founders like you that allow their customers and community to invest are going to win. And in the future, we're trying to build a world where, like, it's just the done thing that you invite your customers if they want to participate, to invest in the early rounds of your startup.
This
it's
is
just
the status quo
expected
now.
Yeah.
Yes.
And you're almost like kind of persecuted if you don't do that, because like, why aren't you letting us participate?
What do you have to hide?
Exactly. Yeah. Don't you love your customers?
Don't you love your customers? We do.
Yeah.
And I think we talk a lot about community in general in the startup space, and this is a great way to grow that and show that and offer those opportunities. And because your business is an opportunity, and it is a sales as a service is always how I look at things. And in this case, investment as a service, like if you really believe in what you're doing and you really know that you can scale it, why wouldn't you?
Right.
Is kind of where my mind goes.
Yeah.
Well, Jonny, it was so great to have you on. Last question. If people want to come into WeFunder as a founder, if they want to become an investor, how can they get involved? What's the best way to get on the radar for new investments, other than looking at the Mom Juice page, which is open? But what is how do they get involved? Because they probably fell in love with this idea now.
Yeah, just go to wefunder.com and then you can browse through startups very easily on there. You can also click on the link to raise capital and learn more. And my email is jonny@wefunder.com, JONNY with no H. And you can find me on LinkedIn.
We'll put it in the show notes.
Yeah. As the president, I got to be external facing.
Yes.
So put it in the show notes.
Put it in the show notes.
But hopefully if you're listening and you like the idea of it, you might make your first angel investment in a startup that you're excited about. And if you're a founder, you're into the idea of inviting your community to invest in you and share in the upside and kind of building that stronger community through kind of fundraising. Would love to hear from you.
I love it. Well, thank you so much, Jonny. And thank you, Jake, for making this happening. We
you're
love
the best,
you.
Jake. Jake sucks.
Thank you so much. And you're going to see everything in show notes. And go check out WeFunder.com. All right. That's it.
See ya.
Woo!
That's a wrap for today's episode of More Than the Hype. If you love this conversation, make sure to subscribe and leave a review. It helps way more than you know. Until next time, stay bold, stay real, and keep chasing the hype.